out there. We hope that you're enjoying 2024 and you're ready for a massive year ahead in trading. My name's Thomas Atkinson, and I'm joined by Tyron Abella. And this kicks off the first of a huge series of live events we'll be doing throughout 2024. And we hope that you're going to learn quite a lot today, and that more importantly, you're going to start to build some foundations for 2024 and what we think is going to be a year not only for traders throughout currencies, indices, and of course commodities, but more importantly, that there's going to be a lot of volatility and a lot of positioning. Tyrone, I had a pretty good break. Did you have a good one? You ready to get into it?
It was a very refreshing break. Welcome everybody to a new year, and we are looking forward to getting into it. We're wanting to take it to the next level this year in conjunction with Pepperstone. We're going to bring you these every week, and we're really looking forward to covering all the topics that we know that you'll love and enjoy, and most importantly, benefit from. So looking forward to it. And the break was fantastic. You always need it, Tom. But very happy to be back as well. We do miss it a little bit.
Exactly, Ty. Exactly. We do miss the markets quite a lot when we're away from them, even for a little period. But you do need to take that break if you can do it. It wasn't an uneventful period, though, I got to say, over the Christmas holidays. Generally, you get pretty low volatility, but we ended up seeing a big start to 2024 with vol spiking across most pairs and actually a relatively good trading time. And I think it's the sign of the times, Ty, that we're getting this now. We're getting a lot more trade opportunity, pretty much 365 days a year, or at least all the trade days of those years.
Pretty much.
Yeah.
And you'll even find something on the weekends as well. But it was a relatively steady period. Very little gapping, which is unusual. Normally you expect a bit of gapping over that period with low liquidity, but there wasn't much gapping, and the market was certainly moving. So for those who stayed in it, I think you probably would have done okay if you were following all the technical rules that we talk about every week. So well done if you did that.
All right. Well, let's get into it. So today we're discussing unlocking volume analysis strategies for dynamic scalping and day trading. I think the thing is, whenever you're talking about unlocking things and understanding things better in the markets, we want to be talking about volume a lot more, because we really want to know where are the bigger players sitting with their orders. Once we start to spot their orders, kind of using a dynamic approach that's a little bit different to the traditional supply, demand, support, resistance, or any of those other kind of concepts, we want to start stacking the overall position, and then we can start to say, okay, let's break it down from a higher time frame to a smaller time frame to take advantage of that from a scalping and day trading perspective. Just before we get started, Ty, we get into some of the analysis. We will be going through, of course, some live market analysis here today, and we'll go through a little bit of theory as well. But we do want to also give a shout out to people if they want to have their questions answered. Feel free to ask them in the chat room right now and throughout today's session, and we'll answer them throughout. So it'll be awesome. But just before we keep getting started, we've got a quick risk warning. We'll see you in just a second. Okay, so Tyrone, volume profiles, a tool that we've discussed a few times here on the channel, but something that we want to bring into some live analysis and some previous analysis of the last couple of weeks to show you how we might use it to find underlying areas of interest for our day trading and scalping strategies. It's a basic yet effective indicator. There are a few different types that we've talked about, but it could really define, I think, the next couple of years, being able to understand positioning and where we want to look for. Now, it's not just a great tool, Ty, for finding out where the entry level is, but it's also a great tool for figuring out where we might have an exit as well. And a lot of that has to do with what we call kind of like an area of equilibrium movement to equilibrium movement, another E. Equilibrium to equilibrium. So if we can move through zones fairly easily because we know where the positionings are, then that allows us to take advantage of this from a day trading and scalping perspective. Be in there quicker, be in there faster, know where our take profits could be. And half of trading really is not so much the entry as it Ty, it's really the take profit and the risk management.
Absolutely. It's amazing how many traders who aren't really adept with looking at the markets in a good way don't actually know their exit or stop losses when they actually enter a trade. They think they'll work it out later. Actually knowing where your entry point and exit points are is probably the most important part. Hitting the trigger is the easy part, Tom. We all know that, but actually understanding the best place to take profit and just as importantly, have your stop loss in place. I mean, if you haven't got a stop loss in place when you're placing the trade, how have you even managed risk? You haven't, is a simple answer. And if you don't know where your take profit is, how do you know that your risk reward ratio is going to be correct or actually in tune with what you should be doing? So that's why those two E's are very, very important, because without them, you're trading a little bit blind. You don't want to be doing that on the fly. So the volume profile is a tool that's come to us in recent time. It wasn't available to us early on in our trading careers, but it's probably one of the most important new tools, I think, that it's available to traders, and probably still a little bit underutilized in the sense that most people don't know how to use it properly. But when you do understand it and use it, I think it can be one of your most important tools in your toolbox.
Okay, so Ty, let's get into one of the examples that I want to use. And I think we're just going to quickly talk a little bit about this chart, which we've discussed in several different live sessions here on the Pepperstone channel. And that is that markets build positions over time. And it sometimes takes a little bit different. Remember, we might be saying, okay, we want to be a day trader or a scalper, but big traders are generally saying we just want a lot of volume. We want big positions. And to get a big position, it has to build over time. So when we talk about equilibrium points to equilibrium points, what we're looking for is big positions to the next level of big position. Basically, news events can push these markets into levels. They can push and break out of these structural zones. It could be a big kind of earnings announcement if it's a stock. It could be something where the market's just decided, okay, now we're ready to go to the next level due to an overwhelming level of orders getting entered into. So you've got to think of it as market structure over time to allow larger traders to get the volume that they need and the liquidity that they must have. And they push and direct markets in these levels. So what you're really going to want to do is you're probably going to want to have at least two trading strategies when it comes to 2024. And one of them is going to be for when markets are range bound. And one of them is going to be when markets are moving in a trend towards that next level of equilibrium. So let's jump into the charts, Ty, and actually take a look at how this might look. We're going to use gold as an example. I'm going to bring volume profile onto the charts here. We'll discuss some of the most previous moves or the previous moves that have happened here. Now, I'm just going to remove this red chart, or the little red list here. And you can see that we had this high and we came down to this low here. Now, most of you would be able to recognize, this is a 2-hour chart, by the way, on gold spot, that this area here had some trade in it. I think anybody could see this. There's been a lot of structural trade where markets have stopped there, then they've broken below, then they've found this level to be a supply, then they've moved down, supply or resistance, moved down, supply or resistance, moved down, then they eventually broke. Now, it's fair enough to think that this level in the future could be of interest. The problem often for scalpers and day traders, where are we going to be looking at? What zone exactly should we be really focused on here? And where have the orders, we know they've been placed around this area, but can we pinpoint that a little bit more? Also, if we have a market that's going in a downward trend and it pulls back and we want to, let's say, move towards a short position, what areas could we be interested in? So let's think about it. It's a little bit of a revisionist theory because, of course, we're going to be loading up here a chart where we've already seen what happens. Let's say we took from this high here to this low here. Now, this is using a fixed range volume profile. And what you're going to notice is it gives us this kind of histogram. And what this histogram shows us is that where all of the trades are being placed. So remember, we've got what we call the value area high and the value area low down the bottom and the POC. This is a bit of an advanced class, so we're going to assume you know what these things are. But basically, value area high and value area low represent the boundaries for 70% of the volume traded over that period. And we're using here a fixed range volume profile. So basically one where we're selecting the range. Now that means that from this high to this low, the most traded zone is right here. Okay, this red line that goes across. And you can see on the histogram that it presents even more information. It says, okay, this one is actually almost a third, probably larger, I would say, Ty, than the other one here. And this one here is quite large as well. So if we were to draw a box, this is what I often like to do as a day trader, is I would come in and I would say a box between that low there and that high there is an area of interest towards us placing possibly a short in the future. The reason why, we know that it was traded heavily on the way down. So if the market comes back to this level, there may be a reaction off this point. And this is where we get very powerful concepts that come through from the volume profile analysis. Now, most people don't use it this way, Ty. They use it where they've got it on the screen and they go, it's basically just being viewed. So it's viewable screen area. Now, the problem with that is it's not going to give you this really down and kind of in-depth version, which allows us to use this scalping and day trading technique. So you can see here that we have the most traded zone, an area, a box of interest, and the market comes up to this. Now, it always comes up to these areas generally when we get some kind of volatility. Now, volume usually comes in, or volatility usually comes in around news events, doesn't it, Ty? So this was obviously a news event. You can see it here by the two big moves. But I often find that we talk about patience, react, don't predict, and an abundance mindset. Most traders that we've met over the years, the ones that do the best, what is one of their defining characteristics, would you say?
Yeah, most definitely. They actually, basically, you could repeat those three words over and over again. They absolutely plan their trades. They wait. They're like chess players. Most of them would be very good chess players as well. They're very, very patient. They set up the trade and then they trade what they see when it happens, not what they want the market to do. It's extraordinarily important. I think it's probably the best trait that all of the good traders have. They actually trade what they see, not what they want to see. And I think that's probably it's the biggest trap for our beginning traders. The market doesn't always do what you want it to do, but when it does, you're ready and prepared.
Exactly. When it comes back to an area that you've already played chess with, we're not playing checkers here, we're playing chess. Yes. When you've played chess with an area, you've found a zone that you believe that is of interest to possibly prepping a system, you have that abundance mindset to wait for that. And you don't really need to have to be forced into trades. Remember, there are so many instruments on the Pepperstone platforms. You've got currencies, you've got commodities. This is just gold, for example. You've got indices, you've got single stocks. These volume profile techniques can be applied to many of those instruments. So we know that this is a point of interest. We know that news may spike us up into that point. And what you're interested at that point is to jump into the smaller time frames. So this is where you can get kind of into that scalping mindset. As it comes back into your red box, how does the market react to it? Do you have a trading system that could be built around something like this? So you can see here the market comes initially in, and this is a 5-minute chart, and rejects back down. It goes pretty fast down, then it rallies back up, then it goes back down again. Now, if you saw a reaction such as this, and on some time frame, remember market's a fractal, it's probably going to look something like a shooting star, isn't it, Ty? On whatever, who knows which time frame it's going to be, but it's going to be one time frame. You can kind of tell here that the structure is showing us that we might be seeing rejections. Now, if that's happening in a zone that you already expect it to be happening at, then there are better chances that when that rejection comes through, if you say, okay, I'm going to wait for it to go through this last low and then possibly look towards shorting it back down to the range, that is highly likely. I'm going to explain why in just a moment, but let's just go even smaller time frame. Let's go 1 minute over here. We aren't going back too far, so we should be able to get the data for it. And we'll look at how it reacts to this information. So you can see here, we get that initial high. We get a sell-off. We can be patient. Okay, cool. We saw a reaction. Could we short it there? We could, but maybe we don't want to. Maybe we want to say, okay, well, let's see how this market's come up. So notice the news comes through. Now, often when news comes through, you'll get these fast reactions and these huge moves. Now, it's easy for us to then go and look at the volume underneath, the traditional volume, and say, look at that. So much volume there, Ty, so much volume. But really, price has moved a heavy amount, hasn't it, during this time? So you might say, well, that's a lot of volume, but I would say that's a lot of price movement. So probably there is a fair chance that the volume that was gone through here is not really fairly distributed. And what markets will often do is they'll come back and fill those zones. So they'll fill some of these areas in the future, giving us areas that we could possibly move to for take profits. Effectively, a movement from an equilibrium to an equilibrium zone, because we know that this is a heavy move. Yeah, there's some volume, but there's probably not that much. And I'll use the volume profile to show you what I'm saying in a second. So the market comes up, the market creates a bit of a structural base, it then goes up, it comes into the area, and then it breaks down. This level then becomes of interest because you can see it was initially supported, then it was sold off from. This area here would be, if you were looking at a short, a place that you would short. And then what you could do is you could use a volume profile tie to look for the next range. So we could take this out and we could say, okay, where were the biggest trades on the way out? Well, the biggest trades were here, weren't they? So would this be a fair place for us to potentially be looking for take profits? I would say, yes, it would be, as a scalper and a day trader, because of course we're interested in being in like this and trying to get out like this. And this trade wouldn't have taken very long to play out. And it's a patience, react, don't predict one, because it happens after the news. I think too many retail traders, too many of us out there get owned, and I'll say owned, we get kind of hurt taking trades early.
Most definitely.
Yeah.
And that's
What are
that's
your
an issue
thoughts
for
there,
other
Ty?
reasons. I mean, look, there's so many reasons to actually, we've just discussed the most important one for what today's topic is, but really the pullback to the 20 moving average was, really your signal. Once you already knew the setup was
Mhm.
there, once you had that series of lower highs and lower lows, you're up to the 20 moving average, bang, down you go. And you know exactly where your take profit's going to be because it's predetermined by the previous market action and the point of control. So, and you've got to be very, very mindful, I think, Tom, and this is where people get a little bit unstuck, understanding that we are on a minute time frame and we're not looking for a $500 move here. We're looking for the move that the market is going to give us, given the research that we've done. The research that we've done is on a smaller time frame. We're absolutely scalping and day trading here. We are not looking for a long-term positional trade. We're looking for a trade that's going to get us to the promised land, which is the point of control, also known as the promised land.
Especially after. But that trading after the news, Ty, is something that just so many people don't do. I remember when we first got into trading back, heavily back into trading 2007, 2008, obviously being stock a little bit before that. But the thing was that what I noticed is what we really wanted to trade the news events. I just felt it. I was like, it's a little bit maybe, adrenaline seeking in some ways. And that's because, well, it's exciting. You see fast moves, you see big returns possibilities, but actually, when you start to really think about it, what the news events are is opportunities for bigger players to grab liquidity because it gives them the ability to push the markets towards directions that they're interested in adding to their position. And it also gives them the ability to potentially trap positions into going the wrong way. Now, I asked this to the chat straight away. You guys out there, by the way, if you enjoy this content, make sure to give it a thumbs up. It does help us out very much, so much appreciated. But one of the things I want to ask you is, have you ever been trapped by being in a trade before news, it going in one direction, it pushing past, hitting your stop loss, hitting whatever the thing you didn't want it to hit, and then all of a sudden going off in the opposite direction and pushing to that level that you thought it was going to go to anyway? Now, generally speaking, the answer is going to be yes, but we'll see whether people have had that one. Ty, has it ever happened to you? I know it has.
Early on, it happened all the time.
Yeah.
And it's one of those things that you have to learn from. I think you nearly have to experience it. We can say it all we like, but I think everybody will probably experience it in some manner. But you'll know it when it happens, and there's nothing more frustrating, that's for sure.
No, nothing more frustrating. Now, unpacking this a little bit more with volume profiles, what I want to really highlight again, you might have already noticed it, is okay, we've got a clump here. And really, volume profiles are just showing us what we already know. We already know there's a lot of trade through here. It just gives us pinpoints to those. And pinpoint accuracy is what we're talking about here. But notice these big candles. You think, oh, look at the volume. Traditional volume says big volume. Look at that. So great. But really, did we see much trade here? The answer is quite simply no. So once we break underneath, and Tyrone mentions that we go back to that 20 moving average, which is a good additional point. 20 moving average, if it's been respected on the left-hand side, it's got a good chance of being respected on the right-hand side. So look at your moving averages. They're actually excellent for entering into strategies where you're using other confluence techniques as well. But there's not much trade here. So it's fair to think that the market will at least try to push from here down to here. And this is just something that I guess we've seen happen a lot over the years, and I think it brings up some great points. Ty C, another Ty, says, I feel like every time it happens to me, lol. Poor Ty. Ty C also says, I find myself taking trades because I feel like I should be doing something rather than nothing. What a great comment, Ty. And that's because it's going to help a lot of people out there. Ty, do you want to take this one?
Yeah.
Help another person out?
Absolutely. People feel just like Ty there, that time invested reading the charts and analyzing the charts equals time that you must enter. Like, say, if you do a 2 or 3 hour analysis session, you feel that you've wasted your time if you don't place a trade. We've always thought, ever since we learned these lessons early on, that actually choosing not to take a trade because there isn't the right setup is actually a trading strategy in itself. It's very, very important. Never feel like you've wasted time if there isn't a good opportunity to actually trade, because only quality setups are the ones that deserve your attention. Don't feel the time invested in analysis should equal some sort of an output in terms of trading, because nothing could be further from the truth, actually, Tom. It's a common mistake that people make, and they find themselves trading poorly most of the time, and then you have to invest even more time to actually try and get those losses back that shouldn't have been there in the first place. And it gets very, very frustrating to people. Then they start to make silly mistakes. So yeah, never feel that way. And always remember that time and analysis, setting up all these chess zones, we can call them, are stories for another day. It doesn't always have to happen in the session that you're looking at. The time, be patient.
Yeah.
Absolutely.
Abundance mindset, guys. If you can look, I think it's a game changer for me. I actually received, I didn't tell you this, but I received about 10, maybe 15 emails over the summer break here in Australia. And I just think this is worth sharing. And basically what those people were doing was saying, thank you for the abundance mindset. And I'm surprised how often I get this. Now, of course, it's not my concept. It's not Tyrone's concept. It's just a concept that I think rings true to so many, because this is not an industry, and this is not the type of job where time, as you said, time in front of the charts equals productivity. It's actually being in control of your emotions. And abundance in general in life, it kind of sounds like that crazy thing, The Secret, Ty, but really what it is telling you is it's just saying, you know what, take a step back. Whenever you feel an emotion such as fear or greed, being FOMO, they're generally bad emotions. That usually means that you're not centered. You are going to lose. And what I've noticed throughout the years is that most historically great investors and traders are almost monotone. You ever seen them in their interviews? You look at Buffett's like, or Charlie Munger, obviously, was like as well. He's a bit funny though. And then of course we've got Druckenmiller as well. Some of my favorite investors. Those guys are all really in the middle line because their temperament is that they don't really feel too many emotions. It's interesting.
100%. Yep. And your favorite of them all, Wyckoff, is actually in black and white. So he's the true monotone because there's no color pictures of him. So
he's a laser printer.
Absolutely, he is. Absolutely, he is. I got 15 emails over the holidays too, but they were all telling me that I was going to be a Nigerian prince and I've inherited a country. But you know what? The abundance mindset maybe not open those emails and actually fall into their trap. So
you didn't click
knowing
links?
that there's a better opportunity out there, you don't need to click on those links.
Are you sure they didn't have compound interest since 1997? I've seen one that said that. It's been saving compound interest since 1990s. All right, so let's move over here to gold. And I've actually just kind of highlighted a low to a high period. And what I want to show you is that this is beforehand. Okay, this is not, you can see how I've got most traded zone. Actually, if you watched our YouTube videos that we've done, I had this one a while ago. Now, what I've done is I've gone from the low to the high, and I've actually pulled it from the whole thing as well. But you can see it's clearly the most traded zone type, clearly. So as a day trader, you said we're talking about zones. We're playing chess, we're not playing checkers. This is a zone of interest. There's no doubt it's going to be a zone of interest. Why? We've seen huge amounts of trades there. And you know the best thing about this is it's not really something that algorithms can hide, and it's not going to be too easy for them to really break this even in the AI world, because this is literally where they placed all their trades. There's a lot of buyers and there's a lot of sellers, and obviously we're looking for who wins. So why we're interested in this is because the market may come down to this point in the future, which it does. Now, you might think, okay, well, big deal. Could it keep shorting through this zone? Absolutely. But we do have evidence that buyers won because buyers pushed it higher. That means that if it comes back down to this zone, which you'll notice is not a traditional support or even a traditional demand level, it's kind of in the middle of it all, that if it comes down to this zone, we could be looking for setups on the smaller time frame. So this is just two opportunities that have presented themselves really in the last 2 weeks. And what I'm saying is it's just these are areas of interest that you could therefore come into as you were day trading. So you could come up here and you could say, okay, well, what am I interested in? All right, so there are a few things that you could look at. We're on a 5-minute chart here. You could be saying, okay, well, I'm interested in taking out this zone up here because we know that there's some resistance up here. You could have said, well, if it comes down to this point, maybe there's a small little upward trade on really small time frames. This could be a take profit. And if we start to form a base like we did, when we do something like this one here, it would be more than likely that there is a decent trade from here, from this level in here, to possibly this level up here. So that could be something that you looked at on the charts. And of course, you could focus on. You can see here it goes up, and you'll notice that it hits into this zone, and see how there's a reaction off that. You can see this is a big level. Look at this level. See this level? This is the level of supply, which you could already have mapped out. So really what you're saying is you're saying, okay, if we hit this point down here, the chance of it moving up to here is fairly high. The chance of it over here moving up to here is looking better. And we can actually track that again with volume profiles. So you can see how many we could stack on the charts. We get pretty wild with it, but it can help you visualize something. We're visual creatures, Ty. One thing I always remember from high school is they employed this dude. I almost want to say thank you to him, actually. He pretty much changed the way I think about studying. But anyway, what he did was he came in and he gave us this idea of creating a storyline to memorize stuff. And what that was is it might be, I think it was like your walk to school. And when you go past a bush, okay, that means, some part of chemistry or whatever you were trying to memorize at the time. And it was crazy how good that was. Also, visualization of saying like sun equals this, and then being able to therefore recall it. If you notice any of those huge, big, high IQ people that want to memorize stuff, they often use those techniques. And I encourage people to go check it out. It's pretty cool. But
very
what that type of stuff, it's super crazy powerful. It's like writing on paper, still one of the best ways of memorizing something, in my opinion, because it's that visualization as well of what you're learning. But what we're talking about here is we're visualizing the charts. We're visualizing Wall Street's entry points, the composite man. Where have they placed the trades? So hopefully that's helping people out there right now in terms of better understanding.
Yeah, and it's identifying these areas. So not actually thinking about it saying, wow, that makes a lot of sense. It's about knowing that makes actually a very logical sense and applying that same setup every time you see it. That's what really trading is. That's where the memory comes in. You want that to be automatic. So basically, when you see that setup and you do the volume profile, you know exactly what you're looking for. You're not trying to create something out of nothing. You know exactly what you're looking for every single time you trade. And you know that when that happens, the probability of that working out for you is going to be far better than just taking a shot at the market and saying, well, I think it might go long or I think it might go short. Understanding the fundamentals of what it does and why it does it is extraordinarily important. And when you can actually do that and memorize the setups, your trading world will change. That we can assure you.
So let's move over to another chart here, Ty, and we've got up a good one, which I'll bring up right now, which is the Australian US dollar. So you're probably thinking, oh, well, that's great. You found some stuff in hindsight. What about the future? What levels could we be looking at? Well, some people, they're going to be thinking that, fair enough. So, here we've taken a chart and we've got the Australian dollar and we've gone from the low all the way to the high. And what I've done here is I'm just kind of showing you that there are clearly two main areas. There's an area here of interest, which the market first came down to. And you can see it responded to that area, which could have been good for day trading. We'll have a look at that in a minute. And then there is a second level, which is this 3 bars down here, in particular, this huge one that goes across this price. Now, could this be an area of interest where we could be playing chess with the market and looking for maybe some buyers to show commitment? It could be. Do we know it's going to activate? Absolutely not. This is where you need to have, this is just a tool for your overall trading strategy on top, which needs to be something based on something like maybe averages. It could be based on schematic, like price action based schematics. It could be based on multiple different, confluence level zones. This is just one of the places where you can build confluence. But we can see clearly that we've got this and we've got this. So what I would have done in this circumstance, I probably would have broken this down a little bit more to a 2-hour chart so I can see a little bit better how this is really distributed. And when we're breaking it down, what it'll do is it'll give us these levels. So you can see here a little bit cleaner, the level we should have been focused on, and then a little bit cleaner, the level we should have been focused on. So these two levels could be very interesting. And for a beginner trader, an advanced trader, an intermediate, this is very powerful because you're often left wondering, well, where's my support? Okay, well, maybe you think the support's there. In this case, probably is because the support and this overlay with each other. Where's my resistance? Where are my potential other places of support or demand? And what you'll notice in this case is you've got demand and a support as well, and it's a volume profile as well. So it's actually 3 different trading systems. Because remember, support, resistance, supply, demand, any other one like a Elliott wave or any of these types of things, they were built because they have statistical edge when used correctly, weren't they, Ty? So they gave us some kind of advantage. But in this case, what we're doing is we're just saying, well, actually, there's 3 different systems sitting on top of each other. That's not bad, is it? It just means 3 different types of traders could be sitting there.
100%. And it just means that there's more eyes on the ball, all looking at different things and different reasons for a market movement to actually play out. Now, is there a guarantee that it's going to get to that level? Well, of course there's not. But if we see a continuation of lower highs and lower lows, and we continue to trade below that moving average, that zone you would expect would be pulling the price to it like a magnet. So, and that's why this is a very valuable area. It's not a signal to short, but it is a signal to potentially look at taking profits if another sell signal happens from where we are now. If we get another lower high, lower low sequence, and we continue to track down following the moving average down, we've got a very viable take profit zone, and that's why this zone is so important.
Yeah. So it's becoming a viable TP zone. You can see on the left-hand side as well that there haven't been too many trades in between this area here. So you can see also it activated itself off the top in this area. So really, it just shows you how it's interacting with these price ranges. And there's really not much going on in between, let's call it 66.84 and that 66.40, which is about 40 points or 40 pips. So that's a significant little area. And then, of course, there could be even further gravitation down into this area. But I wouldn't, as a scalper or day trader, I wouldn't be saying, well, that's going to break easily. It's probably going to take a little while. It might do something like this. Something like that could be a possibility. And as a day trader or scalper, that could be horrible for your mentality as well, for your psychology, for everything else. So that could be a big issue. All right, so let's go here to a couple of questions. There's some questions that have come in, Ty, and I want just to answer them. So one of them was from Sultan. It says, can you teach us a little bit more about weekly templates for day trading, which is direction bias templates? So when you say, I'm not exactly sure what you're talking about here in terms of the way you've questioned or asked the question. But if you're talking about using weekly closes to find how markets positioned and therefore movements to the next equilibrium, the next movement, and that type of stuff, I would agree with you that weekly closes are the real deal. And one of the reasons why that is because weeklies, in essence, hold a fight between the bulls and the bears for that entire week session. They also hold important significance with the closures. So closure prices can be incredibly important, whether you to repositioning. See, Wall Street or Composite Man or any of these large traders, they always have some form of open position. And often what they're doing, Ty, is they're increasing it or decreasing it over time. So because they're increasing and decreasing that position, big closures on monthlies, weeklies, even dailies can actually mean that, oh, okay, now we're going to trim 20%. And we know this happens, don't we?
Yeah, absolutely. Absolutely. Weekly closes are extraordinarily important, and they do really set up the next week's trading when they are in a key zone. But it's like anything, it's always a zone that it's in. It's always really important to understand where the support and resistance is and where these levels are. And if it does fall in the right zone, the weekly is a good basis for daily setups in terms of trend. But the daily chart can't be overlooked, though. I think the daily chart's one of the most important charts to look at for trend viability and trend direction. That gives you probably the most clues out of all of them, especially the way we trade.
Yeah. And daily, weekly, monthly, all very good. Daily in particular, great for day traders out there. So you can see again, just taking from the low down here to the high spike, the area of interest could have been in here, and you can see there's reaction off that. So again, the market's moved fairly swiftly down to that point. Makes sense. The market's found some kind of buyer here. Now, is that before the fact? Absolutely, it's before the fact. Just some examples. Here's the pound, okay? So if we went and had a look at the pound, and I showed you where we moved to on the way down, then you might say, okay, well, where are the two levels that we should be focused on? Now, remember, you've got to kind of think about this not just as, oh, we've got the point of control. This area here has the most amount of trade, but this area here has also a large amount of trade. So, because we know that has a large amount of trade, if it comes back into this range, we could be looking at shorts. We could be looking at take profit zones. If you've been lucky enough to get into trades down here, this could be an excellent level for you to be taking some profit off the table. So, all very interesting levels and things that we'd be looking at with volume profiles. So I think it's time now, Ty, to take it over to some questions in the room. So do you have any questions out there that you want answered? Let us know. There's quite a few of you here. Also a reminder, if you enjoy this type of content, give it a thumbs up. It does help us out. But I think what you've noticed today is that volume profiles are just the beginning of positioning, and that traditional volume, such as the one we've got down here on the screen down below, wasn't necessarily super useful in stuff such as Forex, but we can say that volume profiling work is very, very powerful in Forex as well as commodities and indices. So it's something that you might want to add into your chart analysis and add as a complements tool over 2024. And I think it would be a good place to start with.
Yeah, most definitely. Most definitely. Woolengabba.
Let me take this one.
Yeah, you take that one. Woolengabba.
Yes, Will and Gabba. So good to have you here, Will and Gabba. Welcome to 24. So do you guys use consecutive candle counts? So yes, I use I use, I guess, DeMark concept. So yes, I will do it in terms of if we get candles from the DeMark side of things, in terms of seeing a 7 count or something like that as being overbought or oversold. I think it's a powerful concept, and we'll probably add a live session. So subscribe to Pepperstone's session over this year, and we'll talk about that one. Now, in terms of whether we just use, okay, there's 6, 7, 8, 9, 10 kind of candles in front of each other, bullish, 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 bullish. I don't really use that too much, because you'll notice, like recently we had the S&P 500 hit 8 weeks up, or maybe it was 9 weeks up, quite a lot. And you'd instantly think, well, that means the market has to sell. But the stats behind that, if you go back 100 years and you look at every single one, doesn't present. It presents sometimes a pullback in time, which is a bit of sideways action. But actually, over the next 4 to 8 weeks, traditionally it goes up from a statistical standpoint.
And sometimes it just keeps going. That's a little bit like going to the casino and playing roulette and going when there's a streak of red, you start betting against red, and it's and for the most part, it will do it eventually. But sometimes, Tom, the whole board is completely full. So yeah, most definitely, you've got to tread with caution there, no question. Price action is key, and that's probably far more important. So definitely, look at that one. All right, I think
good comment here, just quickly, Ty. Will Gabba says index counts that are bearish have more weight. That's correct, because they tend to oversell into fear. And if you know anything about indices, statistically, indices do tend to drive higher over time. So I think they've got a slight edge on the bullish side. But do remember, that's one of the great things about currencies and commodities is a lot of the time, especially in currencies, they're floating valuations. So because they're changing all the time, whether you're a bull or a bear, it really doesn't matter. You're just a trader. And there's no real, they're fluid things. So you don't have to go, oh, well, I think this is going up all the time, because it often will be bullish and bearish. And it's a great place for traders to start for that reasoning. So I guess, Ty, from both of us, we would like to say welcome to 24. Thank you so much for watching. If you enjoyed today's session, give it a thumbs up. And we'll see you in 1 week's time. So make sure to put this stuff in your calendar. Links in the description down below to sign up, so you get emails telling you when we go live, when the next one is. And then you can watch it here, and you can watch it back in replay as well, which is awesome. So big thumbs up from me. Big thumbs up, I hope, from Ty. And anything else you want to say?
Ty C, just very quickly on that one. Rather than trading the whole New York session, what I found when I used to do that is I'd rather actually get up early and actually trade fresh. So get up early. So you set your alarm for 4 o'clock in the morning if you're in Australia. Trade the last 3 hours of the New York session. And what I find is that when New York session is trading on its lonesome out of the London sessions, that's when it's at its most smooth and the easiest to trade. So rather than trying to stay up late and falling asleep, trying to set your alarm nice and early and try and trade and get used to trading the last 3 or 4 hours of New York, and you're going to have a far better time doing it. That's my suggestion on that one. That's what I did. So really good. Yeah. Thank you so much, everybody, for joining us tonight. We look forward to seeing you next week, and you have safe trading for the rest of the week with CPI coming up.
Yes, CPI, and remember, earnings season kicks off in the US this week with banks. So this week into next week may be volatile across many different pairs due to the fact that central bank policy changes may be in order depending on what's happening with the economy. Thanks so much. See you very soon. Bye for now.
Thanks, everyone.